Think you might need a business valuation, but not sure? Hi, I'm Daniel Cooper from PCE, and today we'll discuss the 3 most common situations where folks like you might need a business valuation and how you go about it. Are you on the finance team of a company that's recently closed an equity funding round and recently given its employees stock options? Then you'll probably need a valuation. But why is this important? Under the IRS regulations, in particular 409A, it's a requirement that companies like yours get a business valuation to support the process by which they give stock options. What could happen if you don't do this? If you give out stock options with a strike price that's too low, you could be setting your employees up for a nasty tax bill. It's very important that you hire an independent appraiser to come up with the strike price of the stock options and to make sure that those stock options are not in the money at the time they're awarded. And that means that if the current stock price for one common share is $1, then the strike price, the exercise price for the option to buy one common share should also be $1. It should not be 50 cents. If the strike price is too low, that can cause tax problems for your employees. If you just acquired a company, then you may need to do a valuation. One of the important pieces of accounting guidance is called ASC 805. That helps people in finance like you record the acquisition of other companies. This accounting can sometimes be complicated. However, PCE can help simplify that process by providing you with the values of the intangible assets that you'll need to record on your balance sheet. When would you need to do that? Typically within 12 months of completing an acquisition, you would need to work with an independent appraiser on what's called a purchase price allocation. It's an important process to go through to make sure your financials comply with the standards. If you own a business and are considering transferring that business in the next 5 to 10 years, then you may need a business valuation. In terms of succession planning, there are 3 strategies that we see owners typically do. One of them involves gifting the shares to the next generation, and the other 2 involve a sale. One of the sales to an ESOP, which is an employee stock ownership plan, and one of the sales to third parties, which can include private equity. Within the first strategy, you'll need a valuation to attach to your gift tax return, which goes along with your tax return. So that's a valuation that helps determine how much the stock is worth at the time you gave it to your son, your daughter, or someone else in your family. For the second 2 approaches, the sales, you'll need a valuation before you really get going. Because you have to ask yourself, is my business worth enough now to sell it to an ESOP, an employee stock ownership plan, or to sell it to a third party? If it's not, then the process might not be right for you right now. So those are the 3 types of valuations and the 3 situations where you'll need a valuation associated with succession planning. Today we've covered several situations where you may need a valuation, and if you're curious about the nuances of valuations for estate tax and gift tax purposes, check out my colleague Rachel's article. She does a deep dive into that subject, and I think you'll find it really interesting. That article and a link to it is pinned as the top comment. Generally speaking, not all situations will require a valuation, but we've covered today some of the ones that probably will. If one of those 3 situations does apply to you and you think you need a professional valuation, contact us today at PCE. We're experts in all these types of appraisals.